morning. Hedge fund tycoons and Robinhood executives are going to be having their business practices examined under a microscope at the GameStop congressional hearing later this week. Here to talk about the impact it may have on hedge funds and Wall Street, Kate Kelly, reporter at the New York Times and a CNBC contributor, and Dan Primack, business editor at Axios. Good morning to both of you. Kate, I'm curious what you think that this hearing is going to really focus on, given the disparate interests that are going to be at the table. You have everybody from the CEO of Robinhood on one side to Ken Griffin, the CEO of Citadel, for example, on the other. And then you have some of the traders involved in the GameStop trade itself.
Yeah, Andrew, I'm personally really looking forward to it because I think Chair Waters rightly recognizes that this was sort of a hot mess, and there is not even a very good understanding now of what led to all this beyond some Reddit chatter, the use of commission-free trading apps that have become extremely popular, right, like Robinhood. And then on the side, there are some relationships with Citadel and also Melvin that was short the stock. So if there's any ability to sort of untangle what happened in this sort of basic step-by-step mechanical sense with some of the market factors, that'll be interesting. But I think Chair Waters has a tough job. She's got a big committee to work with here. Everybody's going to want to have their moment of political theater, I think. And this is tough stuff for the American public to understand. It's sometimes tough for me to understand. Market structure is arcane. It involves sophisticated technology, though, too. And you've got all these different forces sort of interplaying. So to me, I'm very curious to hear from some of these folks that you almost never see in the public spotlight, like Gabe Plotkin. I covered hedge funds for years and have not met him, although his reputation for good money management up until now really precedes him. I'm very curious to see, for example, what he has to say about the debacle that faced his hedge fund, Melvin Capital, going into this.
Dan, what I'm curious about is, does somebody like Roaring Kitty get treated as a hero or a villain relative to a Gabe Plotkin in this scenario?
I think that depends on who's asking the questions. I mean, for sure, I believe some of the Democrats on the committee are going to treat the Plotkins, the Ken Griffins, the hedge fund piece of this as villains. Yeah, no, I do believe that the Reddit folks will be, I don't know if it's much heroes. I think probably more curiosities. To me, the only real thing they're going to maybe determine here in terms of something we haven't been able to learn yet maybe are more details about the relationship between Citadel and Robinhood. Other than that, I think this is going to be a lot of noise, but not a lot of consequence coming out of it. Maybe some SEC regulations down the road, but that won't be coming from this committee.
And I'll ask this to both of you. On the shorting side, and Kate, you've already written about how difficult this situation has made it, or just made it more broadly, to short stocks and what that means. That's on one end of it. On the other end of it is this idea of a social media-enabled sort of trading frenzy, and whether you think there's going to be either new rules of the road need to be implemented or, frankly, enforcement around what it means to, quote-unquote, manipulate a stock.
Well, you heard in the aftermath of Thursday, January 28th, which was when GameStop peaked intraday at close to $500, and also Robinhood put in some curbs on trading. We now know that's because they needed to put up some cash for a margin requirement that slowed things down for them. But in the aftermath of that, you had the likes of AOC on the one hand and Ted Cruz on the other saying that it was an outrageous situation that sort of needed more regulation. And yet, from everyone I've talked to in the short community, in the legal community, it sounds like the appetite for further curbs is low. The short selling curtailment that occurred during the financial crisis on financial names in an effort to sort of boost banks and brokerages was regarded as ineffective in studies afterwards. And that just doesn't seem like the solution. The other thing that a professional investor versus a less sophisticated investor might notice here is that this sense that the smaller investors who were bidding up GameStop were wronged. Yes and no. I mean, you could argue that we should have free, unfettered markets, and that's one valid argument. But on the other hand, there's a reason why retail investors so often get hurt in these situations, because they may not have the track record, the knowledge to understand how to get out without taking major losses. And so if nothing else, the Robinhood curbs had the effect of kind of lowering and reducing the froth and bringing the stock back to a more Earth-like level.
Shepard Smith here. Thanks for watching CNBC on YouTube.